Hey, Dan Passarelli here. Happy Friday. Well, we had another really boring day in the market again, didn't we? S&P 500 closing pretty much unchanged. Have you noticed something lately, though, about this market? Kind of like that all of my videos lately have been that, hey, the market was higher at the open, then it just kind of stalls. Every rally gets faded. Every dip gets bought. It feels like there's this invisible hand putting a lid on this bull market right now. I want to argue that that hand isn't the Fed. You know who it is? It's option sellers. Over the last couple of years now, the options market has quietly changed how the stock market behaves. We've got 0-day to expiration options, same day SPX and SPY contracts that trade, like either lottery tickets or hedging tools or credit spreads all day long. We've got a boom in covered call ETFs and buffer or defined outcome funds. These products literally sell upside options and generate income. Put all this together that I'm talking about here, and you have basically a structural wave of option selling. And that's where this lid is coming from. When the crowd, the main market, sells options, especially index calls or index call credit spreads, somebody has to be on the other side. That somebody is usually a market maker. If traders and funds are selling calls, then market makers are long these calls. And so to hedge that risk, they don't just cross their fingers and hope. They hedge dynamically. In plain English, that means when the market goes up, market makers sell stock to stay hedged. When the market goes down, they buy stock to stay hedged, or futures if we're talking ETFs, or indexes rather. So if all this short call supply coming from 0DT traders and covered call ETFs and structured products, that forces market makers into a kind of buy low, sell high, back and forth robot mode. It keeps the market in a range. It puts a speed bump on the rally lately. Rallies get sold into by the market makers hedging. And on the other side of that, the pullbacks get bought by market makers hedging. And that's why I think the market can feel like it's grinding higher, but struggling to really explode and having those dips and failing to really bust out of the range. So let's talk about those income products. Covered call ETFs, buffer ETFs, all the stuff that promises monthly income using options. So what is income? It's call premium, right? It's the cash that they collect for capping the upside. Those calls are more like permanent short volatility positions in the system because once one expires, they sell another one. They roll. They're always there. And they're not meme traders. I mean, some of them are, but they're institutions mainly. They're always there, selling a little bit of upside month after month, week after week, sometimes just day after day. And that on top of the intraday 0DTE crowd, like I just mentioned, you get a market that's constantly being tapped on the head every time it tries to run. So what does this mean for you? Well, first, it helps explain the personality of this market. Less wild, straight up melt ups, more grind, more fake outs, more, why did that rally die for no reason? And second, like I mentioned before, it kind of cuts both ways. When market makers are positioned the other way, when they're short options instead of long options, their hedging can actually amplify moves. That's when you get air pockets and nasty reversal days. So the big takeaway is this. The stock market isn't just about earnings and PE ratios. I mean, it is. I talk about that a lot. It's a big deal, but it's not only about that. There's an options ecosystem that has really lately been shaping rallies and dips and keeping the range tighter. If you're trading in this environment and you ignore that, you're missing a big part of the tape reading. I hope that helps. This is Dan Passarelli. Trade smart.